Okay, welcome back, traders. It's Shane. We're going to take you through the key equity hedge strategy. So this is really getting under the hood of what we're doing with the options futures hedge. So let's get straight into it. We're going to do a little bit of a recap before we start. So our next slide, really just to tell you about obviously the goal of the strategy is to provide you with an opportunity to earn consistent monthly returns while managing risks. Now, obviously at this point in time, you've gone through the introduction to options trading, so you get starting to get a good feel for how options work. If you haven't done that, you need to go back and definitely go through that module. So you should be starting to feel as though you're getting a fairly good understanding of how options work and obviously the futures component. So this is about putting those two pieces together as a combined strategy to really kind of work the puzzle out, and you can see the power of the strategy. Very simple, but very powerful as well. So our goal really with this strategy was to give you an opportunity to make consistent returns while managing risk. So first and foremost is capital protection and managing risk, and obviously we want to make sure that we can take advantage of premium in the market, and we'll talk about how we do that shortly. So the other thing we want to do is make sure this strategy is as simple as possible. So there are a number of ways you can trade this, and we'll go through that as well, just trying to make sure that you're spending as little time as possible trading, and ideally you'd potentially use this as a vacation type trading strategy. I wanted to just explain that what you've got now is you've got a very powerful tool that you're going to have to be able to use with your portfolio. But first and foremost, we really need to recognize straight up that that trading is a business, and if you if you really want to be successful as a trader and manage your business and manage your portfolio, you need to treat it like that, because what we find is that a lot of traders or a lot of people buy systems or get training, and they then embrace the freedom that is accompanied with trading, the independence and the solitude, but that's obviously a double-edged sword. We want to still make sure that we first and foremost make sure that we run our trading as a business, and that obviously you can generate great income. You know, you're your own boss, you set your own hours, but really, as we've said before, it needs to be managed as a proper business. So the history of the system. The key equity hedge system has been traded within a private equity fund for about 7 years and has evolved into a robust, consistently profitable performer over that time. It's passed really the ultimate test through the economic downturn that we saw from 2007 onwards. We're still in periods of fluctuating volatility, so the market has a tendency to move, and as such, our strategy and system has evolved based around market conditions. So we think we know that we've got a very powerful tool here that's able to not only take advantage of obviously nice trending markets, but also take advantage of the extreme volatility. All right, so just a little bit of a recap of what an option is. So you've gone through the beginner videos, you'll know now, and you'll start to get a good feeling of the fact that an option is an instrument that gives the owner the right, but not the obligation, to buy a call or sell a put option on an underlying stock, index, futures, or any type of commodity, and it's a contract set at a specific price for a particular period of time, and it's usually for a month, 2 months, 3 months, 6 months, so depending on obviously the duration, but it's definitely a specific set of time or specific time. So an investor buys a call option if he thinks the underlying investment will rise in value. He buys a put option if he thinks the underlying instrument will fall. So options give us that ability to play both sides of the market. Calls for obviously if we're speculating that the market's going to rise, and put options are there for us if we believe that there's going to be a potential fall in the market. So as we have done with our previous example, the example there is that we have the right, we have a buyer who has the right to buy 100 shares of IBM at $1.30, speculating that in a month's time those shares might go up to $1.40. So for that right, he pays away a premium to the seller. So always two sides to an option contract, a buyer and a seller. remembering that the buyer has the right, the seller has the obligation. Okay, so we'll go through this example. We have a house here that's worth $500,000. We have a seller and a buyer. So the buyer approaches the homeowner, which is the seller, and he says to the owner, look, I would like to lock in the price of your house over the next 6 months at a value of $550,000. So that means that if the price goes up to $700,000 within 6 months' time, I can buy that property off you for $550,000, and I'll pay you a premium of $10,000 to actually have the right to that contract, that 6-month option contract. Now the owner thinks, well, the house is worth $500,000. I get $10,000. If it goes up to $550,000, I can sell it for $550,000 plus I keep the 10, so I've made $60,000. The owner is speculating that property prices won't climb at all, so he thinks this is a pretty good deal. So both parties entered into the agreement, remembering that the buyer has the right after 6 months to buy the property at $550,000 if the market value is at that level, and the owner or the seller has the obligation to deliver the property at that price if the market value is at $550,000. So let's have a look at what happened. The house was valued at $590,000 after 6 months, meaning that the buyer actually paid, it locks in $550,000, so there's already $40,000 worth of premium. He paid away $10,000, so we take that off the potential profit there, which gives him $30,000 of profit. The seller's pretty happy because he actually was actually wrong on the where the price of the market was going to be after 6 months, but he's pocketed the $10,000 premium plus the $50,000 in capital appreciation. So he's very happy, but he has now an obligation to deliver the house to the buyer at $550,000. So that's where the buyer has the right and the seller has the obligation.